Well, good morning, everyone, or good afternoon, depending on when you're listening to an old fella like me ramble on about this business of investing. Folks often ask me, after all these years, what's the biggest lesson I've learned? I'll tell you, it's usually learned the hard way, through mistakes, some of them mighty expensive. One that always comes to mind, a real head-scratcher that Charlie and I still chuckle about, though it wasn't funny at the time, was buying Berkshire Hathaway itself. Now that sounds like a crazy thing to say, doesn't it? After all, it's been the vehicle for everything we've done. But the textile business it was built on, that was a mistake. A classic value trap, if there ever was one. What a bonehead move that was, trying to polish a turd, as Charlie would say. I remember back in the early 60s, the textile industry was a dog-eat-dog kind of business. Brutal competition, little pricing power, and requiring constant capital just to stay afloat. But I saw it trading at a low price, cheaper than its working capital, and Ben Graham's teachings were ringing in my ears about buying a dollar for 40 cents. So in 1962, I started buying shares. By 1965, I had control. We paid about $14.86 a share, and the company had a net working capital of $19 per share. Seemed like a no-brainer, a classic cigar butt, one last puff to be had. But what I didn't fully grasp then was that even a cigar butt with one puff left would eventually burn your fingers. I was too dumb, too stubborn to see that the underlying business was on an irreversible decline. We poured money into that textile operation, trying to modernize it, trying to make it competitive. We acquired new looms, we tried different strategies, hoping to turn the tide, but it was like shoveling sand against the tide, trying to swim upstream in a river that just wanted to flow in the opposite direction. We spent a good 15 years in that business, from 1965 to 1985, and it just ate capital. Every dollar we put in seemed to get chewed up and spit out. I was so caught up in the original low purchase price that I failed to adequately consider the economic characteristics of the business itself. It diverted capital and my attention from truly wonderful businesses that were begging for investment elsewhere. The opportunity cost, looking back, was in the hundreds of billions of dollars. I mean, think about what those same dollars could have been doing if they'd been put into our wonderful businesses right from the start. What a costly lesson that was. Here's the deal. What I learned from that mistake with the textile mills at Berkshire and from other similar missteps like Dexter shoes a few decades later is that you're much better off buying a wonderful company at a fair price than a fair company at a wonderful price. Ben Graham, bless his heart, taught me the vital importance of a margin of safety, of buying something for less than it's worth. And that's fundamental, absolutely bedrock. But Charlie, my partner Charlie Munger, he drilled into me over the years that if you buy a bad business, no matter how cheap it seems, it will always be a bad business. It will require constant capital, constant effort, and usually it'll end up draining. It's like planting a tree in rocky, infertile soil. No matter how much you water it, it's never going to flourish like one planted in rich, fertile ground. What Charlie helped me see, what I truly absorbed over time, is the power of a competitive advantage, what we call a moat, a wide, enduring moat around a business, protects it from competition, allows it to generate high returns on capital, and gives it pricing power. The textile business had no moat. It was a commodity business. Anyone could do it, and it was easy to get into and out of. So you were always competing on price alone. That's a race to the bottom. We want businesses that have something special, something proprietary, something that makes it hard for competitors to snatch away their customers or their profits. This isn't complex math, it's just common sense. Think about it. If you own the only toll bridge in town, you're in a great business. If you own one of 1,000 toll bridges, you're in a tough business. You don't need a fancy degree to understand a moat. It's simply asking yourself, why do people choose this product or service over others? And is that reason sustainable? Is it because of a strong brand, like Coca-Cola? Is it because of proprietary technology that's hard to replicate? Is it because of network effects, where the value of the product increases with more users? Or is it because of a cost advantage that competitors can't match? When you find a business with a truly wide and enduring moat, that's when you can sit back and let compounding do its magic. You don't have to keep fixing things or worrying about every competitor, because the business takes care of itself, protected by that moat. This philosophy, born from the pain of textile mills and other cheap but troubled companies, led us to some of our best investments. Take See's Candies, for example. We bought See's in 1972 for about $25 million. At the time, it was making about $4 million a year pre-tax. Now, it didn't look particularly cheap on a multiple basis. Then Graham might have scoffed. But what it had was a powerful brand, particularly in California, a connection with its customers. People had a strong emotional tie to See's, a tradition of giving it for special occasions. It had pricing power. We could raise prices by a dime or two, and folks would still buy it because it was See's. That $25 million investment in See's Candies has generated over $2 billion in pre-tax earnings for Berkshire, without requiring any significant additional capital. It's just kept spitting out cash year after year. That's a wonderful business. Compare that to the textile mills, where we were constantly pouring money in just to keep it from drowning. See's taught us a great deal about the value of an economic moat, about brands that resonate with customers, and about management that understands how to nurture those assets. It changed our thinking about buying businesses that already had pricing power, rather than trying to create it where none existed. Another great example is Coca-Cola. We started buying Coke in 1988, eventually investing about $1.3 billion. At the time, the stock wasn't particularly cheap, but Charlie and I looked at that business and saw a simple, universally appealing product, an incredible global distribution system, and a brand that was ingrained in cultures all over the world. People loved Coca-Cola, and they would buy it regardless of the economic cycle. It had a wide moat built on taste, brand, and distribution. We bought it and essentially put it in a drawer. That initial investment grew to be worth over $25 at its peak, and it's still a huge holding for us. The beauty of it is that it's a simple business, easy to understand. It sells happiness in a bottle, really. You don't need to be a rocket scientist to grasp that. Then there's American Express. Now that was a different kind of lesson, but also about the strength of a business's moat, even in a crisis. Back in 1963, American Express got caught up in the salad oil scandal. A guy named Tino De Angelis defrauded them, and Amex was on the hook for hundreds of millions of dollars, a huge sum back then, potentially bankrupting them. The stock plummeted. People were fleeing, but Charlie and I, we looked at the underlying business. American Express had a deep moat built on trust and a reputation for financial soundness. Millions of people relied on their travelers' checks, their credit cards, their financial service. The crisis was a temporary hit to trust, but the fundamental business of facilitating transactions and financial services, that wasn't broken. It was a crisis of confidence, not a crisis of capability. So we invested heavily. We put 40% of our partnership's capital into American Express at a time when everyone else was running for the hills. We had about $13 million of our $40 million partnership in it. We were buying $1 for 50 cents. maybe less. But it wasn't just a cheap asset. It was a cheap asset in a fundamentally strong business that was temporarily in trouble due to something outside its core operations. It recovered handsomely. The stock price more than tripled within a few years. That taught us that opportunities often arise when great businesses face temporary solvable problems. It reinforces Ben Graham's idea of Mr. Market offering you bargains when he's feeling depressed. And it emphasized to me that an economic moat can weather even a severe storm if the underlying business model is sound. So if you're a young investor today, or frankly an older one, what I'd tell my younger self, what I tell our shareholders every year in the annual letter, is this: keep it simple. You don't need to do extraordinary things to get extraordinary results. What you need is to understand what you own. Never invest in a business you can't understand. If you can't explain to me in simple terms what the business does, how it makes money, and why it has an enduring competitive advantage, then you probably shouldn't own it. It's really quite simple. Don't get caught up in fancy jargon or complex financial models. The best businesses are often the easiest to comprehend. Focus on understanding the economics of a few businesses that are within your circle of competence. My circle is pretty small, mostly things like insurance, consumer products, utilities, things that don't change too rapidly. I don't invest in things I don't understand, like cutting-edge technology companies, because I just can't predict their future. I can't tell you who the winner will be in 5 or 10 years in a rapidly changing industry. I don't understand the underlying technology well enough to gauge the strength of their moat. Stick to what you know and expand that circle slowly, carefully, over time. It's better to have a deep understanding of a few things than a shallow understanding of many. And here's another thing about human nature. People think you need to be constantly doing something, constantly trading, constantly making moves to succeed in investing. That's just not true. In fact, it's often the opposite. Most of my day, I'd say 80% of it is spent reading. Annual reports, 10Ks, industry journals, newspapers, anything I can get my hands on that helps me understand businesses and the world. I just sit here in my office in Omaha, reading, thinking. We don't have a trading desk. We're not watching stock prices flicker by the second. The market is there to serve you, not instruct you. It's not a scoreboard to tell you how good you are. It's a place to buy or sell when it makes sense for you. Patience, discipline, and a long-term mindset are your best friends in this game. This applies to any business, not just investing in stocks. What really matters in business is finding an enduring economic advantage, nurturing it, and having rational, honest managers running the show. We look for good people to run our businesses. People who are passionate about what they do, who treat the business as if it were their own. I try to buy businesses so wonderful that an idiot could run them, because eventually one will. But jokes aside, having capable, principled management is absolutely crucial. We trust our managers. We give them autonomy. We don't meddle in their day-to-day operations. They know their business far better than I ever could. My job is capital allocation to make sure the money is put to its best use. We've been fortunate at Berkshire to find extraordinary managers like Ajit Jain, who runs our insurance operations with incredible skill and intelligence, and Greg Abel, who oversees our non-insurance businesses. These are people who understand their businesses inside and out, who are focused on long-term value creation, not short-term quarterly results. That kind of management, combined with a strong, enduring business model, is what creates real wealth over time. It's not just about the numbers, it's about the people and the culture. If you have the right people in place, they can do wonders, even with a decent business. With a wonderful business, they can create magic. But that's not the only lesson I learned the hard way. There's another kind of mistake that's just as insidious, and it's the mistake of omission, the great ideas you let slip by. This reminds me of another time, not about buying a bad business, but about perhaps being too rigid in my thinking, too slow to adapt. For years, I avoided what folks called tech stocks. I remember sitting here in the office with Charlie, and people would ask us about all these new internet companies, these software giants. My response was always the same. I don't understand it. It's outside my circle of competence, and that's generally a good rule. But sometimes a business that looks like one thing is actually something else, something simpler, something more aligned with what you do understand if you just open your eyes a bit. My long-standing aversion to tech companies meant we missed out on some incredible opportunities, and that cost us a lot of money. The most glaring example, and one where I eventually had to eat my words, was Apple. For years, I just lumped it in with all the other tech companies I couldn't understand. I saw it as a hardware company, a gadget maker, highly susceptible to technological obsolescence. What a fool I was for not seeing it for what it truly was for so long. Charlie always tells me, Warren, sometimes you need to update your software, and he was right on that one. Around 2016, we started buying Apple shares, and now it's our biggest holding by a long shot. Our initial investment was around $36 billion, but that holding is worth well over $150 billion today. What changed my mind? I started to look at Apple not as a tech company, but as a consumer products company with an incredibly sticky ecosystem and a powerful brand. Millions of people, billions even, use an iPhone every day, not just as a phone, but as an indispensable part of their lives. It's a status symbol, a personal assistant, an entertainment device, a connection to the world. It's deeply ingrained in people's habits. It's a habit just like Coca-Cola. What I learned from finally seeing Apple clearly and investing in it is that your circle of competence isn't static. It can expand, but you have to be willing to learn, to adjust your thinking, and to admit when you've been wrong. Charlie always says the greatest ability is to be able to change your mind when the facts change. I was stuck on the hardware company label, and it prevented me from seeing the extraordinary consumer loyalty and the power of its brand and ecosystem. It's like Ben Graham taught me, price is what you pay, value is what you get. But sometimes the value isn't just in the balance sheet, it's in the intangible power of connection and habit. The lesson here is simple. Never stop learning. I spend 5 to 6 hours a day reading, soaking up information. It's how I've learned everything I know about business and investing. You've got to be curious. The world changes, and while human nature often doesn't, how we express that human nature through products and services certainly does. The power of a brand, the stickiness of a product, the convenience it offers, these are timeless aspects of business, whether it's a candy bar or a smartphone. The underlying principle of understanding why a customer chooses one product over another and why that preference is durable, that's what matters. Another example of a business that looked simple but had incredible underlying strength, and where we've had a long history, is Geico. I first encountered Geico when I was a student at Columbia, reading their annual report after Ben Graham mentioned it. I was so impressed by their direct-to-consumer model that I took a train down to Washington, D.C. on a Saturday morning to learn more. There, I met Lorimer Davidson, who later became CEO, and he spent 4 hours explaining the business to me. It was a revelation. Here was a company with a significant cost advantage over competitors because they sold directly, bypassing agents. This allowed them to offer lower prices while still earning good profits. That's a powerful moat. My father ran a stock brokerage during the Depression, and I remember him talking about insurance, but I never fully grasped the beauty of Geico's model until that day. I invested $10,000, a huge sum for me back then, around half my net worth, and it quickly went up 50%. But then I sold it to put money into another investment. What a dumb move. Many years later, in the mid-70s, Geico was struggling, nearly collapsing due to mispricing its policies. People thought it was dead, but I knew the core business, the direct-to-consumer model, was still brilliant. It just needed fixing. We started buying shares heavily, eventually acquiring the whole company. Today, it's one of the crown jewels of Berkshire, generating billions in profits every year, all thanks to that simple, powerful moat of a low-cost structure. It shows that even a fundamentally sound business can stumble, but if the moat is still there, the value can be resurrected. So what's the practical wisdom from all this for someone looking to build wealth today? First, stay curious, but don't fall for fads. The world is full of people trying to sell you the next hot thing, the complicated strategy, the guaranteed returns. Ignore them. The fundamentals of good business don't change. Second, learn from your mistakes and be willing to change your mind. Stubbornness can be a virtue in holding on to great businesses, but it's a vice when it prevents you from seeing new realities or admitting you've made a bad call. Third, cultivate patience. Investing is not a game of speed. It's a game of waiting for the right pitch and then letting compounding do the heavy lifting for you over decades. You don't need a high IQ. I've seen people with 60 IQs fail spectacularly in investing because they lack emotional discipline. What you need is a sound temperament, the ability to control your emotions, and the willingness to be independent in your thinking. When everyone else is panicking, you should be calm. When everyone is euphoric, that's when you need to be cautious. Be fearful when others are greedy, and greedy when others are fearful. It's a contrarian approach, but it works because the market, Mr. Market, is often irrational, swayed by fear and greed. This philosophy really applies to life as much as it does to business. What you look for in a business, integrity, clear purpose, lasting value, you should look for in your own life and in the people you associate with. Choose your heroes wisely. My dad taught me about integrity and fiscal responsibility from a young age. I delivered newspapers as a kid, saved every penny, filed my first tax return at age 30. My dad ran a stock brokerage during the Depression, and he always emphasized honesty. That early training, those lessons in deferred gratification and simple hard work, those were far more valuable than any fancy financial theory. Charlie and I, we've been doing this for over 60 years together, and our partnership at Berkshire is built on these simple principles. We focus on durable competitive advantages, run by honest, able managers, bought at a fair price, and held for the long term. Our favorite holding period is forever. We don't try to predict the economy or the stock market. We focus on what we can understand and control. We spend our days reading, thinking, and playing bridge. I still live in the same house I bought in Omaha in 1958 for 30. I still drive myself to the office every day. It's a simple life, focused on what truly matters. After more than 80 years of doing this, here's what I know for certain. Investing success doesn't require rocket science. It requires a sound intellectual framework, patience, and the ability to control your emotions. Don't diversify so much that you own a piece of everything, because then you own a piece of nothing. Put your eggs in a few baskets you understand intimately, and watch those baskets very carefully. Don't be afraid to sit on your hands and do nothing for long periods. Sometimes the best investment is no investment at all.
94 now,
And if I could tell young investors one thing, it would be this: start early, learn the basics, and focus on understanding businesses, not just stock prices. Compound interest is the eighth wonder of the world, but it needs time to work its magic. Don't chase trends. Don't speculate with money you can't afford to lose. Avoid debt like the plague. I've never borrowed significant money personally, and Berkshire maintains a fortress balance sheet. Understand that investing is about owning a piece of a business, not about trading pieces of paper. I'd never bet against America. This country has an incredible ability to innovate and bounce back from any challenge. The free market system, for all its imperfections, has created more prosperity and opportunity than any other system in history. So be optimistic about the future. Find good businesses that benefit from that progress and stick with them. You don't need to be brilliant. You don't need inside information, and you don't need to spend all your time worrying about the daily gyrations of the market. What you need is patience, discipline, and a clear understanding of value. Find wonderful businesses with wide and enduring moats, managed by honest and capable people. Buy them at a fair price, and then just hold on. Do that, and over time, you'll do just fine. Thank you.